the market has corrected. We're down 12% from the highs. NASDAQ's down 21%, one of the biggest corrections since the great financial crisis. So we have to assess whether the market has discounted enough all of the bad news that it will need to absorb over the next 6 months, whether it's inflation, interest rates, the war, possibly a recession, and whether this is an attractive time to start buying stocks. We've decided that it is, that the market has been evaluating this for the past couple of months, what's coming, and that's the reason that stocks have fallen to about 17 times next year's earnings. And there are many opportunities with stocks that have fallen 50% or more. There's 150 names on the New York Stock Exchange and NASDAQ that are down 45% from their 12-month high. And that's just a lot of companies to choose from. And if you're careful and you evaluate what you're buying and you have a balanced portfolio, we think this is a time to make some investments in the market. All
right, so which dips are you buying there? What kind of stocks, Carrie? Because we were seeing many of the 150 names. What goes to the top of the list?
Well, so again, there's a mix. So there are some that have fallen even more than that, 70% plus. PayPal and Twilio, they're tech names. But PayPal went from a multiple of 50 times earnings before the pandemic to about 18 times this year's earnings now. And then we bought Fidelity International. All the payment companies have come down. That's selling at 12 times. Charter Financial, Blackstone, that's a great diversified financial and in real estate and funds, private equity. And because of its exposure in Europe, that stock's been hit. American Express, we like. O'Reilly Auto Parts, that's a different sort of name, but there's still a shortage of cars, new and used, and people are driving in. We expect that oil prices will start to come down. Well, they have started to come down, but gas prices will start to come down. On names like Waste Connection and even United Healthcare is an attractive name here. And those are names that are not way on the spectrum of high growth that have come down precipitously. But if you are interested, you have more of an appetite for risk, I would nibble at Shopify, DraftKings, Zoom, DocuSign. Those are all stocks that are down over 50%.
Even Netflix is down massively during that time frame. So brand names and tech, to your point, Carrie. So before we let you go, we got a few moments left here. Would you go back to buying big tech, like the Apples, Microsofts, and Amazons of the world? Is that a good trade?
Well, that's an interesting question because Apple and Microsoft had held up extremely well. They were two of the top performing names, in the S&P in terms of contribution to return last year. They have not come down as much. I think both of them are considered bond surrogates, or they're money market funds to people. They sold high-risk stocks and put the money into Apple and Microsoft and Google to some extent. I think Amazon, which underperformed last year, Amazon was flat and the market was up 29%. I think Amazon is more attractive here.